For most new investors, the term index fund may be confusing. In this video, I will examine the composition of index fund, the benefits of the fund, and the risk embedded in the asset class. Welcome to my channel. Time to subscribe. Okay, let us move on. So, what is index fund? An index fund is a diversified basket of stocks or bonds and created to be a representative sample of the stock market, meaning it mimics the composition of the stock market. Again, index fund is a tool to measure stock market performance. So, why is this important? Well, index funds save you time and effort, more so for the new investors who do not have the time and effort of researching several thousands of stocks. An index will quickly summarizes the performance of the stock at a point in time. Therefore, if and when you are new to investing and say you do not understand how to evaluate a company fundamentals, yet want to invest, a reliable route is index fund, because a single index fund is an investment strategy created to make available to you a well-diversified set of asset classes. However, before I soldier on, it is important to let you know who created index fund and why. The fund created by Jack Bogle in 1975 to save investors from paying managed fee charged by portfolio manager. In effect, index fund is a passively managed fund. For example, the S&P 500 index fund is a passively managed fund that mimics the S&P 500 index. Again, Jack believed that an actively managed mutual fund often underperform the market average because of high fees and expenses, while index funds have lower expenses and fees. Another unique advantage of index fund as against actively managed fund can be summed up like this. Index funds are more tax efficient than most actively managed funds. What does it mean? It is a normal practice for portfolio manager to make more purchase or sales when the index provider makes changes to the index. Well, here is the problem. Anytime a fund manager sells a holding, there are tax implications for everyone who owns shares of the fund. While index funds do not buy or sell investment as much. And again, please note there's a difference between mutual fund and index fund and ETF. And to know more about ETF, please check my video titled Why ETF Portfolio. You will see it at the end of this video. And in addition to some of the attributes of the index fund mentioned earlier in this video, the index fund perform better than the mutual fund with higher returns. Again, index fund encourage long-term investing. Why? Because your investment appreciate over the years, unlike mutual fund. And index fund is embedded with automatic investment features that ETF lacks. So, what are the best fund to invest in? And what are the metrics to consider as you choose your index fund? Well, in my opinion, and based on some reliable data, a good way to start is to examine the composition of some of the basic fund. The S&P 500 index fund, for instance, tracks and focuses on the best 500 companies on the stock market, while the Schwab's total stock market index fund with ticker symbol XWT, XS, is the combination of small and the big cap companies and tracks well over 500 companies. Again, you want to check for a brokerage company that charge a lower fee. And if you are like me, who consider customer services, user-friendly and easy to navigate platform, and above all, a lower fee as a necessary metric to consider before you choose your broker, then I would say Charles Schwab's tick all the boxes. Check out the Schwab International Investors account if you reside in the UK. Again, I am not financially incentivized by Schwab to carry out this review. It is my opinion. Please do your research. Meanwhile, there are other brokers like Vanguard and Fidelity in the state who also have lower expense ratio. Okay, let us examine the Schwab Total Index Fund. As you can see, it's got 0.03%, meaning the fee is low. A good way to start, very encouraging. And the index has 10 holdings. And again, very, very diversified across different sectors like information, tech, finance, real estate, and utilities, etc. However, you should be aware of the risk embedded in index fund, such as you cannot choose, pick, and control your exposure to companies you do not like or want. And gains at times might be low. Do not forget that index fund tracks the stock market. In effect, it mimics the up and down as well in corrective and impulsive pattern. But in the long term, it will always appreciate, turn bullish if you like. And some of the stocks within the index may be overrated. Again, some stocks within the index may not perform very well. Nonetheless, it will not have a significant effect on the overall performance of the index fund because other stocks within the index will make up for the shortfall. Let us examine the Schwab Total Index Fund performance for the past month to date. Again, you will realize that for month to date, it has been very positive. Average return is very positive. Though there are several other index funds that is worth looking into, like the VG SLX that tracks REIT and real estate and give higher returns, and the VBIAS that tracks bonds and stocks. The FTSE 100 All World Emerging Index tracks performance of emerging markets, while the FTSE 100 index tracks the performance of 100 largest companies traded on the stock exchange. Please do your research. Okay, here comes the best part. Subscribe and comment below. Remember, the goal is to generate wealth, build companies, and create jobs. Bye now. See you soon.